Howdy, y'all. Welcome back. It's the weekly economic update for Monday, January 10th, 2022. Hope everyone's having a fantastic day and had a good weekend. It was pretty nice here on the Front Range. Had some pretty mild weather. Got a little bit of snow. I guess that was Saturday afternoon, maybe this much, just enough to kind of glaze everything over and make it slippery, but not too bad. If it's your first time watching, be sure to hit the like button, the subscribe button, and share this with some friends and family. I'm sure they'd appreciate some no-nonsense advice or commentary from someone who isn't going to blow smoke up your ass. So, all right, well, let's go ahead and jump into the weekly update. All right, week on Wall Street. A jump in yields sparked a more aggressive sounding Federal Reserve. Sent the market lower to start the new year. The Dow Jones fell 0.29. The S&P 500 declined 1.87. NASDAQ was hardest hit, dropping 4.53. And international was down 0.55. The tech wreck. The perception of a more hawkish Fed put a hard stop to this year's positive start and pushed bond yields higher and stocks into a broad retreat. Technology and other high valuation shares were particularly hit hard by rising yields. Even the larger capitalization technology companies with strong cash flows and profits were damaged. As yields trend higher, investors are questioning if these companies can lead the market in 2022. Fueling this decline was a 4-day sell-off of technology companies by hedge funds that, in dollar terms, represented the highest level in more than 10 years. Stocks continued to struggle into the final trading day, unsettled by renewed climb in yields and an ambitious employment report. The Fed's surprise. Minutes of December's FOMC meeting were released last week, and it revealed a more hawkish Fed than investors had been expecting. One surprise was that the first hike in interest rates could occur as early as March. Another, and perhaps more consequential surprise, was the idea of beginning a balance sheet runoff by the Fed following the first hike in the federal funds rate. A balance sheet runoff means that maturing bonds won't be replaced with new bonds, the result of which is a smaller Fed balance sheet. Many investors view this step as removing liquidity from the system, a departure from the market expectations that the balance sheet would remain flat during the Fed's pivot to monetary normalization. All right. So, I personally would like to see the balance sheet go back down to zero. That'd be ideal. I know that's probably not realistic, but $8 trillion is a lot of money to, be sitting in the public's hands, essentially. And I think the American people would like their money back. All right. Some economic data coming out this week. The Consumer Price Index comes out on Wednesday. Thursday, we have jobless claims and the Producer Price Index. Friday is retail sales, industrial production, and the University of Michigan's Consumer Sentiment Survey. We have companies reporting earnings this week. Infosys Limited on Wednesday. Thursday is Delta Airlines, Taiwan Semiconductor Manufacturing Company. Friday is JP Morgan Chase, Citigroup, Wells Fargo, BlackRock. And that looks like it for the weekly update. I do have a monthly and a quarterly update going out. I'm not going to read through all of it. Let's just go to the quarterly and see what the quarterly wrap-up is. As far as performance, you're welcome to read these. If you're part of my mailing list, you get these in the mail. All right, so quarter-to-date change. The Dow Jones was up 7.37. The NASDAQ was up 8.28, and the S&P 500 was up 10.65. So a pretty strong quarter. Looks like the large cap domestics did the best, followed by technology and the NASDAQ, and then your blue chips, your Dow Jones probably fared I don't want to say poorly. 7% is pretty good for a quarter, but compared to the other three, certainly not as robust. All right, let's go ahead and jump into an article here. This is from First Trust, Brian Westbury, the chief economist there. This is titled "Job Market Making Progress." All right, so let's go ahead and breeze through this. Many analysts were disappointed by last Friday's job report for December, but we think the headline masks an overall report that shows continued improvement in the labor market and a possible surge in small business startups and entrepreneurship. Non-farm payrolls rose 199,000 in December versus a consensus expected of 450,000. Payroll growth was revised up a combined 141,000 in October and November, which brought total growth to still short but respectable 340,000. This was the fourth time in the last 5 months that payrolls missed consensus expectations. However, even as payrolls have recently fallen short, civilian employment, an alternate measure of jobs, has been rising fast, including a gain of 651,000 in December and an increase of 1.09 million in November. Over long periods of time and after some revisions, the two surveys closely mirrored each other, but in the short run, they often deviate. Reading too much into one survey over the other and every short-term gyration in the data is a mistake. This is especially true when we account for COVID. The design of the civilian employment survey makes it better able to capture small business startups, and we think that's a potential reason for the slow recent growth in payrolls. Entrepreneurs are leaving established businesses, some whom are supposed to fill out the payroll survey, and setting up their own shops, which can't fill out their payroll survey because the labor department doesn't know enough about each of them. One possibility is that people who've been working from home feel less attached to large employers and are more willing to strike out on their own. That's what I've done. Or maybe it's a concern about some big company requiring vaccines that's making some workers leave those employers. Only time will tell. I know I would quit. No one's jabbing that crap in my arm. Either way, we think more small business startups is a good sign for future job growth. Overall, we think job growth will be strong in 2022. Payrolls rose 537,000 per month in 2021 and should be revised up in the next couple of months. For 2022, we expect job growth of 325 to 350,000 per month. So by late 2022, total jobs finally exceed the pre-COVID peak. Meanwhile, jobless rate should fall to 3.5%, where it was right before COVID. Normally, job growth this fast would be associated with a very rapid real GDP growth as well, but this is not normal, quote unquote, economy. Lockdowns have damaged supply chains severely, and the government has grown substantially in the past couple of years, with federal spending setting peacetime records as a size of GDP. Add in the Federal Reserve and its money printing and demand surge. The regulatory state is growing too fast, too. This increase in the size of government, even if some of it is hopefully temporary, will come with a cost. And we think that means slower production growth, output per hour in 2022. Think about it from this perspective, or from the perspective of many businesses which have struggled to hire the workers they need. They have more of an incentive to keep their most marginal, lowest productive employees in the hopes of being able to eventually train them into future profitability. Business beggars can be choosers, and with less selectivity, will create a headwind for output per hour, even as the labor market continues to heal. In turn, that means profits should grow, but not nearly as quickly as in 2021. We are still bullish, but we also know that no bull can run forever. And while some think some weak data signals the end, looking beneath the surface is important. So certainly that is definitely some good information there as far as I know I cover the jobs numbers and how many people were employed 2 years ago versus now, and we do have that 3 or 4 million person gap between the people that were employed 2 years ago versus today, even though the unemployment rate is fairly close to where it was at that time. So there is some disconnects. I am hopeful that in the end we should see things get back to normal. Now, whether or not, what is going to collapse first? Is it going to be, the markets and the economy? Number two, will it be, the dollar? Will it collapse and fall apart and we'll have to figure out something else? Or will it be the U.S. government? I think, within the next decade, I think all three will collapse at least once. But, hey, we'll see what happens next. All righty. See here. Next article I have is from John Malden, A Path-Dependent Year, WWJD. So let's go ahead and jump into this. It's a pretty long article. I'm not going to read everything, but this is a gentleman that I pay for his advice or his commentary, and I feel like I should share some of this with you. 22 years of tradition dictate I begin the new year by forecasting what lies ahead. Unfortunately, the future is never really knowable. Forecast is a polite synonym for guess. The best ones are informed guesses, but still inherently uncertain. The coming years are particularly uncertain. The economy could be wildly different based on how certain events unfold. To use a favorite central banker term, it's path dependent. The path we take will depend largely on the decisions of people and a virus, which again depends on the decisions of people in key positions. Some evangelical Christian groups would wear cryptic little WWJD pins. It stands for What Would Jesus Do? That's a good question to ask when you face a moral dilemma. The economic dilemma, while different, becomes clearer when we ask what certain morals will do. What will be our framework as we consider what 2022 will bring? In this part one of our 2022 forecast, we consider three decision makers but it is not entirely clear whose decisions will matter most. An especially difficult challenge. WWJD is our first question for 2022. In this context, it means, what will Jerome or Jay do? That is Jerome Powell. Jerome Powell and the FOMC committee he leads have no good alternatives. Choices their predecessors made years and decades ago limit what they can do now. Choices they made last year certainly have an impact. Powell and the FOMC must choose, and their constrained choices will constrain the economy in 2022. So, keeping interest rates, at or near zero coming out of the last financial crisis are having, ripple effects or shock waves, a decade more, to where we are today. So while it was nice to keep those interest rates at zero, you could get mortgages at next to nothing. Now we're having to deal with the consequences of those actions. The main challenge is inflation. Going into 2022, the Fed expected higher inflation, but thought it would be transitory. To be fair, I and many others initially thought the same, but by early summer, I was asking for a refund on my Team Transitory t-shirt. Inflation rose more and lasted longer than we expected for two primary reasons. First, rising wages and poorly targeted pandemic relief gave some Americans enormous new spending power, while the continuing virus threat discouraged services consumption. So consumers spent on goods, many of which had to be imported. This snarled overly optimized supply chains that couldn't adapt to rapidly shifting conditions. Second, energy prices popped higher in the summer months due to a combination of weather, OPEC policies, U.S. policies, and an unfriendly ESG environment, which reduced production as demand for goods grew. This was exacerbated by a serious lack of investment to produce more oil and natural gas, let alone the ultimate clean energy solution, nuclear. Which is now socially and politically out of favor, but more necessary than ever. Whatever your political beliefs are, energy is an output to pretty much everything else. So other prices rose too. Yeah, I'm a big fan of nuclear. My son, he works on a reactor in the Navy. I'm always trying to push him when he gets out of the service to go into that field, because I think that is going to be the future. And being able to create clean energy is that the masses can have. I think my idea is little generators that you have in your backyard or whatever, and it powers your house. So that's my crazy idea. I'm not a nuclear scientist, so I don't know exactly how you do it. That's why I lean on people smarter than me, like my kid. All right. The FOMC finally belatedly is acting to reduce its bond purchases. Their last minutes indicate the QE purchases will end in March, and a rate hike could come that same month. They also dropped a hint about actually reducing the balance sheet. I applaud their desire to move faster, but color me skeptical on the last part. The only reason to reduce the balance sheet, which unless done in real size is meaningless, would be to give them cover for not raising rates, which would be a serious mistake. If the U.S. economy cannot handle a 0.75% interest rate, we are in deep kimchi. And now the Fed is simply becoming a little less loose. They're still expanding the balance sheet. Real interest rates are still negative, and will remain so unless the Fed hikes far more than anyone expects or inflation drops faster than anyone expects. Note, the negative real interest rate policies of elite economists is seen as a feature, not a bug. They were part of the solution after World War II to bring the debt to GDP ratio down from 150% down to under 50%. The other part was massive GDP growth. It would not surprise me at all, though it would disappoint me greatly, if inflation drops to 3 or 4% range and the Fed essentially accommodates it. But let's come back to the main thrust. We must first realize quantitative easing was intentionally designed to push up stock prices. It was not a surprise to policymakers, from my friend Pete Bhattacharya. And here's his quote. I want to quote here what former Fed Chair Ben's arsonist turned firefighter Bernanke said in a November 4th, 2010 editorial he wrote in the Washington Post, defending QE1 and the onset of QE2 in terms of its impact on stocks. With respect to QE1, and at the time the newly implemented QE2, this approach eased financial conditions in the past and so far looks to be effective again. Stock prices rose and long-term interest rates fell when investors began to anticipate this additional action. Easier financial conditions will promote economic growth, and higher stock prices will boost consumer wealth and help increase confidence, which can spur spending. Increased spending will lead to higher incomes and profits that, in a virtuous circle, will further support economic expansion. Thus, rather than relying on savings, investment, and a quicker income to drive economic growth, QE was specifically meant to lift stock prices in order to do so instead. It's not a symptom of QE, it was the direct intended effect. In reverse, the response in stocks should not be a surprise. So what he's essentially saying is that when you pull take the punch bowl away from the party, potentially you're going to see stocks recede in price, with that action. All right. So all of this is a problem because financial markets are hooked on the Fed's drug infusions. Free liquidity, or better than free in real terms, is Wall Street's fentanyl. The U.S. Treasury is similarly addicted. Withdrawing extra stimulus, while necessary, could have significant side effects if done too quickly. By continuing, it will have side effects too, namely an overheated economy and even higher inflation. In other words, the Fed has no choice but to aggravate someone this year. In 2018, faced with such a choice, Powell crawdadded and gave markets what they wanted. Now the stakes are far higher, and so are the risks. So what he's talking about there is back in 2008, the Fed started raising interest rates slowly, and the market reacted very, very poorly. I imagine that President Cheeto leaned over on Chairman Powell and said, "Hey, I want to get reelected in the next couple of years. You need to do something about this." And then what they do, they started lowering interest rates again, and now we're back in the same position. So, will the Fed, backtrack to hopefully, or to not hopefully, to save a stock market, or whatever financial disaster looms ahead of us? I would give it a probability of greater than 50%, just because these people are cowards. But hey, I could be completely wrong. These people could stick to their guns and actually do what they say they're going to do. So, all right. Well, that's everything I had there as far as articles. So I'm gonna go ahead and stop there. Like I said, it's a pretty long read, but John always has some excellent stuff. Excuse me. All right. Now I have two quick videos. These are probably the two best things I listened to over the weekend. They're both pretty long, so if you're going to listen to these, I would recommend putting them on like 1.5 speed, because this first one is an hour and 50 minutes. It's from Robbie the Fire Bernstein. He is the co-host of the Part of the Problem podcast, and with Dave Smith, and he also has his own podcast where, in today's guest, he has on Mr. Gene Epstein. Gene used to be the economics editor at, I believe, Barron's. I could be wrong there. And he was also a professor, I believe. So one of the smartest men. I actually met this gentleman last summer at Freedom Fest. I have a picture with him, and met him and his wonderful wife, and hope to see him again sometime soon at one of the upcoming festivals this year. But let's go ahead and listen to this and see what they have to say. They're talking about, I believe, global warming, and talking about how that's talking about how it's calculated, and the myths and such. So let's go ahead and give it a listen.
So I know. So that's another clue that natural forces must be in the saddle, that we are affecting it at around a 1.1 to 2% margin, but that 98% is the principal reason why the Earth is warming. Do you have a question of that before I proceed?
No, yes, I guess I do have a question. It sounds to me that we're saying that we can't really correlate man-made carbon with cooling or heating, because we've seen both of those incidents outside. Like we've seen when we're using a lot of carbon that the world was actually not getting hotter, and we've also seen that it's gotten hotter before. Yeah. So how do you correlate exactly that 2% of what's going on even has anything to do with human carbon? It just sounds to me like it's kind of removed from what we're doing altogether.
Okay. Well, all right, but with then the answer to your question is, with that said, Kunin, who's a strictly honest scientist, says that we know based upon science, we know a priori that carbon dioxide and methane, which is human influences, do have a warming effect. They do have some effect in locking heat into the earth. So therefore, he actually has a nice homely analogy. He says that suppose you eat an extra cucumber every day, that you have a certain diet, and then you eat an extra cucumber every day. And then the second year you eat an extra 2 cucumbers and maybe an extra 2.5 cucumbers. We know that the extra cucumbers you're eating, which have very few calories, but if you're eating them every day, then they are clearly calorically contributing to the potential for your weight gain. But then we also know that 98%
if you're eating Twinkies in the afternoon, that cucumber's not making much of a difference.
Precisely.
Right.
Okay.
So it's technical. It's like, yes, it makes a difference. You're eating one too many cucumbers, but against the Twinkies that you're eating, it's kind of irrelevant. So it's technical. So it's the same thing here. It's like the carbon that we're emitting, yes, technically, it does something, but compared to what the earth does, it's kind of irrelevant. If you can fix the earth first, then you can start worrying about our carbon. And even as it is, it sounds like it's cyclical. So it's probably not like it's either not much to be concerned about, or it's not so much that we need to stop our carbon, but we need to be inventing technology so that we can kind of offset what the earth is going to naturally do.
Okay, just a moment, Robbie. Okay, look, I like the way you like to repeat. That this is the Rob Bernstein way that I really like. You try to read back to me what I've said, and then I can correct it a little bit. I can say, again, as usual, Rob, you're about 90% right and about 10% full of shit. What you just said.
So I'm just like global warming. I'm basically I correlate perfectly with the percentage that carbon's actually making a difference.
With respect to that, the Twinkie versus the cucumber thing, I also want to say that because I'm a big aficionado about weight gain and weight loss, is that it's not just the Twinkies, but obviously, for example, by analogy, how much you exercise, how many carbs you eat, because carbs affect the way the calories are processed. So there's so much else, as he likes to point out, that determines your weight gain, your weight loss. So we now have to create a model, however, for the cucumber effect. This gets to your question about models, Rob. Don't you remember? You asked a question about the models.
Yes.
So the point is, this sets the stage for the fact that if man's influence, the cucumber effect, is really like having a 1 to 2% effect at the margin, then you have the daunting challenge of constructing a model that can figure out all of the natural influences and then tease out the man-made influences and see how they affect global warming. And so that in itself should tell you that it's almost an impossible task, because there's so many complex factors affecting the climate. We don't understand them all completely in terms of empiricism. And the punchline is, as he puts it, because he knows model building through and through, the punchline is that the models are gibberish. They use a blend of about like 40 models. The models differ by something like 5 degrees Fahrenheit in terms of the results. The models differ by more than the amount of global warming over the last century. That in itself should tell you that they're going in all crazy different directions. So there's a kind of a fraud at the root of this, which is that we're constantly hearing about the models. The UN is constantly publishing the results of the models, but really all it does is sort of average the results of the models. And what happens on top of everything else is that the model builders actually tweak their models. If they don't like the results, they tweak them, they change them. So there's just no science involved at all in this model building. But again, if you back up about it, you can realize that if I just took you, Rob, and I tried to build a model about how much the cucumber effect is influencing your weight gain or loss, then we probably recognize that there's so many imponderables. Like, for example, as I said, how much your carbohydrate intake, the exercise, all of the other factors which we don't fully understand. We probably could not figure out the influence of the cucumber effect, even in Rob Bernstein, and even though we know something about weight gain, and that's why he says the models are gibberish. Now, but there's more to the story than that. But you have something else to say?
Yeah. So
all right, we'll go ahead and stop that one there. I think Mr. Epstein's point necessarily is that it's such a complex issue, and trying to just take a model, and from what he was saying is that the modelers will, if they don't like the way it comes out, will tweak it and adjust it to get the results they're looking for. Not shocking, it's global warming's a big business. So unfortunately, making it seem like it's the worst thing in the world is very profitable for some people. So, all right. And then this next one is from Lex Fridman's podcast. He had Jay Bhattacharya on. I've listened to Jay on a number of different shows over the last couple of years. Seems like a very well thought out, and he was one of the people who published the Great Barrington Declaration. So he's on Lex's podcast talking about COVID and such. We'll listen to a couple of minutes of this. Again, I will, if you do choose to listen to it on your own time, it's about 2 hours and 20 minutes. Lex is a very, long, it's kind of like Joe Rogan, but, more for nerds. It's a good listen. So let's go ahead and jump in and give this a couple of minutes.
To our best understanding today, how deadly is COVID? Do we have a good measure for this very question?
So the best evidence for COVID, the deadliness of COVID, comes from a whole series of seroprevalence studies. Seroprevalence studies are these studies of antibody prevalence in the population at large. I was part of the very first set of seroprevalence studies, one in Santa Clara County, one in LA County, and one in, with Major League Baseball around the U.S.
If I may just pause you for a second, if people don't know what serology is and seroprevalence, it does sound like you say zero prevalence. It's not. It's zero, and serology is antibodies. So it's a survey that counts the number of antibodies
specific to COVID. Yes.
People that have antibodies specific to COVID, which perhaps shows an indication that they likely have had COVID, and therefore this is a way to study how many people in the population have been exposed to or had COVID.
Exactly. Yeah, exactly. So the idea is that we don't know exactly the number of people with COVID just by counting the people that present themselves with symptoms of COVID. COVID has, it turns out, a very wide range of symptoms possible, ranging from no symptoms at all to this deadly viral pneumonia that's killed so many people. And the problem is, if you just count the number of cases, the people who have very few symptoms often don't show up for testing. We just don't, they're outside of the ken of public health. And so it's really hard to know the answer to your question without understanding how many people are infected, because you can probably tell the number of deaths. That's even though there's some controversy over that. But so the numerator is possible, but the denominator is much harder.
How much controversy is there about the death? We're gonna go on a million tangents. Is that okay? I have a million questions. So one, I love data so much, but I'm almost tuned out paying attention to COVID data because I feel like I'm walking on shaky ground. I don't know who to trust. Maybe you can comment on different sources of data, different kinds of data. The death one, that seems like a really important one. Can we trust the reported deaths associated with COVID, or is it just a giant messy thing that mixed up? And then there's this kind of stories about hospitals being incentivized to report a death as COVID death.
So there's some truth in some of that. Let me just talk about the incentive. So in the United States, we passed this CARES Act that was aimed at making sure hospital systems didn't go bankrupt in the early days of the pandemic. The couple of things they did. One was they provided incentives to treat COVID patients, tens of thousands of dollars extra per COVID patient. And the other thing they did is they gave a 20% bump to Medicare payments for elderly patients who are treated with COVID. The idea is that there's more expensive to treat them, I guess, in the early days. So that did provide an incentive to sort of have a lot of COVID patients in the hospital, because your financial success of the hospital, or at least not the lack of financial ruin, depended on having many COVID patients. The other thing on the death certificates is that reporting of deaths is a separate issue. I don't know that there's a financial incentive there, but there is this sort of complicated, when you fill out a death certificate for a patient with a lot of conditions, like let's say a patient has diabetes, that diabetes could lead to heart failure. You have a heart attack, heart failure, your lungs fill up, then you get COVID, and you die. So what do you write on the death certificate? Was it COVID that killed you? Was it the lungs filling up? Was it the heart failure? Was it the diabetes? It's really difficult to disentangle. And I think a lot of times what's happened is people have erred on the side of signing it as COVID. Now, what's the evidence of this? There's been a couple of audits of death certificates in places like Santa Clara County, where I live, in Alameda County, California, where they carefully went through the death certificate and said, okay, is this reasonable to say this was actually COVID, or was COVID incidental? Mm-hmm. And they found that about 25% of the deaths were more likely incidental than directly due to COVID. I personally don't get too excited about this. I mean, it's a philosophical question, right? Ultimately, what kills you? Which is an odd thing to say if you're not in medicine, but really it's almost always multifactorial. It's not always just the bus hits you. The bus hits you, that you get a brain bleed. Was the brain bleed that killed you? Would it have burst anyway? I mean, the bus hits you, killed you, right?
The way you died.
All right, we'll go ahead and stop that one there too. It was, both of those are very good interviews. I would strongly suggest, if you have time, either watch them on YouTube, or if you use a podcatcher, you can find those podcasts listen in audio form. I personally like audio just because I can put my earbuds on and do stuff around the house and get stuff done, or just play it on the speakers. So anyways, like I said, those are a lot of good information in those. You're gonna definitely get a different perspective on global warming and the COVID situation. So All right. Well, that's everything I had for today. God damn, I went for 30 minutes. So I apologize for going so long. So hope everyone has a fantastic Monday evening, and I'll be back tomorrow with the Liberty Call. If anybody needs anything from me, don't hesitate to email or call, and have a wonderful evening. Bye-bye.